Hello, and welcome to the video on the Statement of Cash Flows, Current Cash Debt Coverage Ratio, and Free Cash Flows applied to PepsiCo's 2017 Annual Report. This corresponds to Chapter 12 of your textbook. So, PepsiCo's 2017 Statement of Cash Flows basically follows the format that you learned in the earlier chapters of the book. Cash flow from operating activities plus cash flows from investing activities plus cash flows from financing equals the change in cash before the exchange rate effect. They didn't tell you about this little part, which usually isn't a big thing, but there's a little minor thing in real reports of multinational companies, which we'll talk about later. PepsiCo generated net operating cash inflow of $9.994 billion by getting more cash from customers and getting more cash for interest received than it paid to employees, then it paid to suppliers and tax authorities, and then it paid for interest owed. Like most companies, PepsiCo spent more cash to buy new property, plant, and equipment, to acquire companies, and to make financial investments than it received from selling them. This makes net cash flow from investing activities negative, which is why it's in parentheses, $4.403 billion. And then finally, PepsiCo spent more cash repaying old loans, buying its shares, and paying dividends than borrowing new loans or issuing new shares, which leads to a net cash outflow of $4.186 billion. This is not unusual for a company of PepsiCo's size, maturity, and cash generating ability. So we said cash flows from operating activities plus cash flows from investing activities plus net cash flows from financing activities. That subtotal would be $1.405 billion. Add the small amount exchange rate effect on cash to get the change of cash of $1.452 billion. What is this exchange rate effect? Well, most large multinational companies like PepsiCo need to have cash including checking accounts in foreign currencies so they can do international business. These currencies appreciate or depreciate relative to their own functional currency, which is the dollar for PepsiCo. So there's an exchange rate effect on foreign cash. So you'll see this thing. Don't let it scare you. It's something that's beyond the scope of this course. Unless it's a really big number for the company that you're analyzing, it's probably not worth you to look further into it. We said that they could have got the same information just by looking at the change in the balance sheet. So the change in cash, $1.452 billion, should tie into the change in cash on the balance sheet. So they proved this, showing that change in cash, $1.452 billion, plus cash at the beginning of the year, $9.158 billion, which is the same as cash at the end of the prior year, equals the ending cash on the balance sheet of $10.61 billion. We know that there's cash, but we say cash is a shortcut, but most of the time the statement of cash flows reconciles cash and cash equivalents. So cash can include checkable deposits, money orders, and currency, and cash equivalents are added to this, which are highly liquid investments with original maturities of less than 3 months or less. So things like treasury bills that you can cash in without expecting to lose money, that or due 90 days or earlier. Finally, there's more disclosure required either at the bottom of the statement of cash flows or in the footnotes, like PepsiCo did in footnote 13 for the statement of cash flows. Companies disclose cash, interest payments. You can compare it to cash. You can compare it to interest expense on the income statement, income taxes paid in cash versus provision for income taxes on the income statement because there are timing differences. And occasionally there's a thing called a non-cash investing financing transaction, which important exchange of long-term items occurs that doesn't involve cash. We still write that just so investors know. Like, let's say you sign a lease and you get a new piece of equipment. You'd have an increase in a investing activity when you had the new equipment, an increase and then you'd have a financing activity, a lease payable, but none of these would involve the exchange of cash. If you didn't put the supplementary information there, you wouldn't see any detail about it anywhere else. Okay. Analysts consider cash flows from operating activities, the first section of the statement of cash flows, the most important one. Like most companies, PepsiCo uses the indirect method for the statement of cash flows, which starts with all net income. Not just net income for PepsiCo shareholders, but all net income of $4.908 billion. And it makes some adjustments. It's like taking a recipe, making adjustments, taking one ingredient, adding a bunch of others to convert it into cash, to convert net income to cash flows from operating activities. The second step, many items on the income statement don't involve an initial inflow or outflow of cash, but eventually they do. So non-cash expenses like depreciation and amortization are added back because they don't require cash, but they reduce net income. Things like restructuring charges, initially they're expense when you make the restructuring, but they might not be paid out like severance packages for several periods of time. What PepsiCo does is write this year's restructuring and impairment charge and subtract any cash payments made toward these this year. Finally, step 3, step 3, which was not needed for PepsiCo in 2017, is to add back non-operating losses. So that could be something like a loss on sale of equipment, because the cash flows related to the sale of equipment belong in investing activities, not operating. We neutralize a loss by adding it back. Similar, subtract non-operating gains. Let's say gain on retirement of debt. Debt is a financial obligation. Any cash flows from retirement of debt belong in the financing section. So these are here. These are neutralized or added back when they're a loss, subtracted when there's a gain, because these cash flows belong in a different section, not operating section. And step 4, we look at non-financial current assets other than cash. So we don't include cash or short-term investments, but all the other things like receivables, prepaid items, inventory, we look at them. So if receivables increase, you would subtract them, because an increase in receivables, meaning you extend more credit to your customers than they're paying you cash this period, that's a drag on cash flow relative to income. If receivables decrease, that means you collected more from old receivables than you granted new credit. That's good for cash this period. Step 4B applies this to non-financial current liabilities, and it says add an increase. If accounts payable goes up, that means you bought more things on credit than you paid for them, and you'd subtract a decrease. If you have wages payable go down, that means you paid more wages than you incurred new wage expense. So that would be a drain on cash. Now the next two sections, investing and financing activities, usually have fewer items, and the main items here with investing activities are buying and selling property, plant, and equipment, which are called capital spending when you buy it, and then they usually have an item for sales of property, plant, and equipment. Buying new property, plant, and equipment decreases cash. This is why the number $2.969 billion is negative. When you sell old property, plant, and equipment, like you sell your old car before you buy a new one, cash came in of $180 million, which is similar to when you sell your old car. Usually you get less than what you pay for your new car. Other things they do are buy other companies. Acquisitions decrease cash if they take over another company by using cash, and divestitures, when they sell another division, that would increase cash. Short-term investments, remember short-term investments are current assets, but because they're financial, they belong in investing activities. Financial investments are here. What happens is you can buy, when you make a short-term investment, that's a cash outflow. When a short-term investment becomes due or matures, or you buy it back, you're going to see, so maturities or when you sell them, cash comes in. So purchases of financial investment decrease cash. Sales or when they mature increase cash from investing activities. From financing activities, we're going to look at long-term sources of, we're going to look at financial obligations and we're going to look at equity. So borrowing or issuing long-term debt increases cash. You take a loan out, initially you get cash, you can put it in your bank account, but if you have to pay back the principal, that will decrease cash. Remember, the interest payments are in cash flows from investing activities, which is weird, which is US GAAP. You have a different option to put interest paid here in financing activities under IFRS, financial principles or financial standards. Okay. What do you do to your shareholders? How can you give your shareholders money? Well, there's two ways: pay cash dividends or use cash to buy back shares, either of which decrease cash. So you can give shareholders money by paying them a cash dividend or buying back shares from those shareholders who decide to sell. This causes you to spend cash. Finally, when you issue new shares, this increases cash, and this even includes the amount that you receive when an executive gives you money to exercise his or her stock option. Of course, when an executive exercises a stock option, the part that represents compensation to the executive, you have to have a withholding, so you don't get all the cash because you have to withhold some compensation. You have to withhold income tax payable on behalf of the executive. Okay, we're looking at these numbers on the statement of cash flows. We want to use them for comparisons to analyze it. The current cash debt coverage ratio measures liquidity, the short-term ability to pay obligations. We take cash flows from operations, $9.994 billion, divide it by average current liabilities from this and last year's balance sheets, and we get 0.48 times. So current cash debt coverage ratio covers about half of average current liabilities. The 2017 current cash debt coverage ratio shows Pepsi generated 48 cents of cash flow from operating activities in 2017 for each dollar of current liabilities. It did a little better in 2016. PepsiCo was less liquid in 2017 because generating 48 cents of cash for every average dollar of current liabilities is less than generating 54 cents of cash as it did in 2016 for every average dollar of current. Another form of analysis we can do with this statement of cash flows is to calculate free cash flow, which indicates solvency, the ability of a company to survive over a long time. Free cash flow is calculated using numbers from the statement of cash flow, all of which are in different sections. Net cash from operating activities from the operating section, that's a subtotal, $9.994 billion in 2017, minus capital expenditures, often called purchases of property, plant, and equipment, from the investing activities section, $2.969, minus cash dividends of $4.472 billion, you get free cash flow of $2.553 billion. The 2017 free cash flow of $2.553 billion means that's how much of cash flow from operations is left over after deducting capital expenditures and dividends. PepsiCo was less solvent in 2017 with free cash flow of $2.553 billion versus having free cash flow of $3.137 billion in 2016. Much of this difference is because of the one-time increase in taxes paid for the 2017 Tax Cut and Jobs Act. Of course, PepsiCo's management can decide how to define these ratios for themselves. These aren't audited items. Most textbooks define it similarly to what we did up here, but they have a little section where it's a non-audited free cash flow that they use for management, which, surprise, is a lot higher because it excludes cash dividends and it adds back cash from sales of property, plant, and equipment. So companies can kind of make their own ratios for management purposes. Usually, in my opinion, they usually look a little bit better. Please feel free to use this presentation as a review before looking at other companies' annual report. For the weekly discussion board, good luck and get started, Jaspers.